Thank you all for coming back. Right, final panel session of the day. And when I was planning the conference, I had the bright idea of trying to do a panel about the Asia Pacific ILS market a decade from now. And obviously during the sessions today, a lot of people have made comments about the future of and what needs to happen. So I'm going to ask my panelists to be clever about their answers so that we provide perhaps something new for the audience today here. But I've got a great group of people. So to my left, Cheryl Tann, partner at Rajah and Tann Singapore, one of the leading law firms in the region, who's worked on a number of, perhaps all of the ILS transactions. Next, Tim Yip, Executive Director and Portfolio Manager at ILS Advisors, who are the longest standing Asia-specific ILS advisory and fund manager in the space, and also help other people with advice and structuring. Next, Michael Bennett, Head of Derivatives and Structured Finance at the World Bank Treasury. Now, the World Bank's activity in this space obviously needs no explanation, and Michael's been behind a lot of that for quite a long time now, and is a great contributor to the market as well in terms of sharing what the World Bank thinks about ILS and cat bonds. And at the far end, we've got Simon Cloney, CEO of Steadfast Re, a leading reinsurance broker in the Asia-Pac Australia region, and particularly known for growing the use of alternative capital in Australia as well. So it's great to have Simon with us too. So to begin, I thought we'd start with some broad thoughts as to why should Asia and the Pacific region really grow its insurance-linked securities activity, what's in it for cedents and investors, and how can we get more activity to be stimulated. So as I said, we've touched on a lot of this through the day, so it's down to the panelists really to try and give us something new. And Simon, can start with you as the reinsurance broker on the panel. Perhaps you can talk a bit about the important role ILS can play, what you've seen, how Steadfast Re has been helping to encourage cedents to look at it.
Sure. Thanks, Steve. Thanks very much. It's nice to be in Singapore. And thanks to Artemis for organising another great event. You do a fantastic job, you and your team. I think the way to sort of try and think about the future is to look back a bit and see what happened, because it sort of paints a bit of a story, particularly in Australia, which became an early adopter and a big adopter of collateralised capacity and ILS. ILS really sort of came to Australia in about 2007, but it didn't really take off until Christchurch, when there was a big need for additional capacity, particularly down low, and the reinsurers moved north up the towers, as they tend to do after events, which was fair enough. And so by then, the ILS world, particularly the collateralised world, post-Katrina, was really starting to motor, and the Australian opportunity with pricing and with structuring, and particularly with aggregate deals, which are much easier to collateralise than a cover with a reinstatement, especially one that's prepaid or free, depending on how you think about it. So we saw that really develop, and it really became a big part of the market, and lots of ILS funds came down to Australia and invested their investors' money in various structures. And that all went swimmingly, so to speak, until we got to sort of from 2012 until 2019, when we had the big fires up and down the East Coast, which really was a sort of almost Armageddon-type scenario. And as always, and always through all my time of working with the ILS world, the claim side is the easiest bit. They are amazing, and we've never had any trouble ever since we first started doing it in 2003. That was our first sidecar. In fact, it was called RLS then, Risk-Linked Securities. So the fires came along, and we collected about $1 billion for those fires, quite a lot of that from the ILS world. And then along in 2022 came the floods, again, another sort of Armageddon. And I guess to sort of quote one of the funds, they said, "The bushfires took us down, but the floods finished us off." And then we saw an absolute exodus of ILS capacity, quite rightly, having paid all the claims, they just couldn't take it any longer. And so they sort of disappeared. They're still there, but the capacity is much smaller. So I guess that story is, how does that story not happen again? But it's important to understand and be respectful for those people that did leave.
Yeah, and perhaps some of that talks to the discipline that Paul was talking about earlier as well, and whether that's maintained. Michael, obviously a key facilitator in the market and issuer as well, been very active this year too. What are your broad thoughts on sort of the benefit of ILS for the Asia Pacific region? Obviously, you had transactions here in the past as well, so perhaps you can specifically reference what the World Bank has done and can do here.
Yeah, thanks, and thanks for the invitation, and particularly this panel, because we at the World Bank we see Asia Pacific as a real growth opportunity for us in what we're doing in the cat bond space and the reinsurance space generally. I would say in terms of development here, if you think of sort of the three major groups you need to develop a market, I would say one already exists, and that's sort of the market infrastructure, service providers, the law firms, custodians, administrators, accounting firms. I think we clearly already have that capacity here in Asia. I mean, certainly Singapore, Hong Kong, Tokyo, Sydney, as well. We certainly have that capacity on the infrastructure side. Then you need investors to really have a local market. We have been doing a lot of work in Asia the last 3 years, particularly focused Singapore, Hong Kong, to try to develop investor interest in ILS. I always think it should be there. It's very interesting for me because I spent most of my time in World Bank Treasury not selling cat bonds, but selling our AAA product. Our very liquid AAA product pays about 20 basis points over U.S. Treasuries. And bringing that product to this part of the world, we always heard, or I always got the response, no, Asian investors need much more risk, much more reward. They're going to compare their fixed income portfolio to what they can get in Macau or at Marina Bay Sands. They need risk. And so your AAA, don't talk to me about AAA. You bring us something risky. Now we've got something risky, high reward, much different risk-reward profile than our AAA product, certainly. And so makes me think there's a market opportunity. All the other reasons, uncorrelated asset class, diversifying for a portfolio. So I feel like investor interest should come, and that will develop over time. So then there's the third group that's needed, and that's the sponsors, the suppliers of the risk, and that's where we're doing our work, particularly on the public sector side. And I can say from work we've done around the world with public sector potential sponsors of cat bonds, there are probably three major benefits of cat bonds to public sector entities over or when looking next to traditional reinsurance. And one is clearly a lack of credit risk, that governments are very sensitive to credit risk. And for a government, there's a very, very big difference in general between getting your insurance uncollateralized from a single A-rated, I'm talking about long-term debt rating, single A-rated insurance company as opposed to getting something either fully collateralized or collateralized by, in our case, the AAA World Bank. Very, very significant difference in terms of how most governments would look at that risk. So that's a big benefit of cat bonds. Another big benefit of cat bonds for public sector, and again, public sector, of course, very much at risk for being audited later for whether they use taxpayer money effectively, is the transparency of order books in cat bond transactions. So when we do a cat bond transaction as opposed to reinsurance, and we do reinsurance as well, but when we do a cat bond transaction, we end up with an order book usually of anywhere from 20, if there's a public transaction in the hundreds of millions, 100 million or above size, we end up with an order book with anywhere from 20 to at most maybe 45 investors. And we see where they quoted the price all the way across an indicative range. And that is a very high level of transparency compared to when we do a reinsurance transaction, where ordinarily there's either a small group of reinsurers who are giving us quotes, or in fact, there's one lead insurer that set the price. That's a very significant difference for a government that we get from the cat bond market. And the third big benefit of cat bonds for public sector sponsors that I see is the leverage it gives a sponsor vis-a-vis reinsurers if we're looking to backfill or to fill in capacity that we can't get from the cat bond market. So cat bond market does have its limitations, and one is capacity. If we want to do a 300 million parametric earthquake deal in any country, hopefully we'd be able to do it, not guaranteed always. And so there is a need to fill in with reinsurance. But when you have a cat bond and you're working on a cat bond at the same time, it gives a tremendous amount of leverage over reinsurers. Maybe that's not a great point to make if this room is mainly reinsurers. But what it allows us to do is to say we're placing this cat bond. Let's say we're going to be buying 3-year coverage. We're going to be buying it on these terms. If you want this deal, you need to come in 3 years coverage on these terms. So it takes away a whole layer of we only want to do it 1 year. We want to reset the price annually. It takes away, we want you to use our insurance contract, not somebody else's insurance contract. It gives a great deal of leverage. So it provides a lot of benefits. So we think in theory, investors in this part of the world should be interested. We think the same reasons public sector entities in other parts of the world have found cat bonds attractive should be the same here in Asia. There's certainly no lack of risk. Sometimes people ask me at some of these panels, well, what about for your clients? What about cyber? What about new risks? Certainly we're open to that, but we've barely scratched the surface on traditional NatCat. So we certainly don't need to go to cyber or other new risks in order to bring a lot of public sector risks in this part of the world, because just looking at tropical cyclone and earthquake risk, we've barely touched the mountain of risks that exists in this part of the world. So very optimistic about the market out here.
Yeah, that's a good point. With the 80-90% protection gap, there's a lot of work to do in NatCat alone here. Moving to you, Cheryl, you've worked on many of the cat bonds here in Singapore, and perhaps you can speak to the sort of the role of ILS within Singapore's capital markets, what its growth could mean for the local marketplace and insurance constituents here, and also how you and others in the market are helping to promote things.
Okay, so I'll address the question in 3 parts. The first part on the role of ILS as part of Singapore's capital market. Well, the first thing is that it has definitely, as all the other speakers have talked about, given investors the opportunity to diversify their investment portfolio with alternative financial instruments. And I think it has encouraged innovation in the financial sector and contributed to the overall sophistication of our capital markets. And the second part on what the growth means for local capital markets and insurance constituents. I think firstly it has increased volume and activity in the capital markets by attracting global investors and reinsurers, and this contributes generally to the depth and liquidity of the Singapore capital markets. Secondly, I think it has attracted more service providers to try to set up shop in Singapore, consider setting up shop in Singapore, for example, insurance managers and structurers, and this ends up creating more high-value jobs in Singapore, and this would eventually lead to a more comprehensive pool of local talent to support ILS issuances and also stimulate our economic growth. The last part on how our local market can promote further activity, I think we would still need continued support from our MES with ongoing enhancements to the current regulatory framework and to continue supporting and facilitating the issuance of ILS as it develops. And the last thing is, I think we still need to educate investors on the potential benefits of ILS, and this will eventually lead to greater demand, and the market can develop naturally from there.
Sure, thank you, Cheryl. And then Tim, finally turning to you, obviously a rare ILS manager based in Asia. What's your thoughts on what's needed? I know we had quite a discussion about this the other day. What's needed to really stimulate some more specific activity?
I think there's a few things. One of the, with the cat bond part, on the cat bond side that both Hong Kong and Singapore are trying to promote, I think this size the required for the issuance causes quite a lot of anxiety or execution risk on some of the sponsors, and so even though it's paid for, you still have to get it done. But I think in this part of the world, a lot of the risk that's being ceded to those investors are quite new, so it's not comfortable for them yet. So I think realistically, it will be more of a, especially in the beginning, more of a collateralized market than a cat bond market. The focus should be around there, because the programs are smaller and it can fit in a bit better with the traditional reinsurance market. So one of the struggles I think that happens is because Asia, outside of Japan and Australia, is it's done through Singapore, or the way it's the regional hub is Singapore. All the markets, besides, say, for myself over here, or the ILS managers, are on the other side of the world. And so if you think about like how the transaction works, is if the client is, say, in, I don't know, Beijing, and then their day-to-day client manager happens to be in Beijing as well, their placement team tends to be in Hong Kong. That Hong Kong placement broker may not have that relationship or with that person in Bermuda. And so maybe he then contacts Singapore or the regional head office, or then to London and so forth. So that it's difficult for that person, that placement broker in Bermuda, that's on the same team as him, who doesn't know that client that well, to be able to place it, and things get a bit difficult. Also, no one wants. I used to be a broker, right? No one wants to to markets outside. No one wants to share brokerage and stuff like that, right? So I think we need to bring that. Ideally, that would be closer. And so, for example, for me, we focus a bit more on Asia because we're here, and so it's easy for us to speak with the brokers here who are day to day with that client. And I think actually for Simon, and in Australia, it's a bit different as well, because they're dealing day to day with London directly. Mm-hmm. And so there's a big Australian placement team in London, same as Japan. Yep. And so those guys are used to placing to those markets. They have that relationship. They know your client, or the guys that you're talking to. But I don't think it's the same between Australia and Japan. But so I think hopefully there will be more managers based here. And I think naturally that we would transact because we're close to them, and brokers can be quite convincing if they're in the same place as you.
Sure, and I think the brokers would probably welcome having more capital around them as well, which actually ties in well to my next question for Cheryl. What are you hearing from sort of the companies you've worked with so far on transactions here, and also what, in your view, would make for beneficial regulatory developments to help expand activity here in Asia?
Okay, so I think one key aspect in Singapore or that we hear about is about lowering of compliance costs, and this is something that the MES is constantly looking into. For example, the MES last year had announced that the paid-up cap for newly incorporated SPRVs would be $1, and other feedback that we have received so far include things like change of the board composition, lowering the number of directors that you need on these SPRVs, because then this would lead to lowering of the related costs of professional indemnity insurance. And other things will include things like, that could be an issue, would be things like audit actuary costs to comply with ongoing reporting standards. So these are one of the key aspects that I think companies want to see improvement in. From an Asian perspective, in terms of what would make for beneficial regulatory developments, like Tim said, I think there needs to be a lot of collaboration across the region, and definitely among regulators and industry participants, because then best practices can be shared, and the challenges that each jurisdiction faces can also be addressed through this collaborative platform.
Mm. Yeah. And do you think if there were more local ILS asset managers, would a transformer be useful?
It could be, yeah. It could be useful in that sense, yeah.
So let's talk a bit more broadly about sort of what else realistically can be done to expand sort of the offering here in the region. And I'm going to go back to you, Tim. When you speak with cedents, what are they looking for? And are there specific developments that you think can actually give them that, if they're, or help to stimulate more transactions to actually get done locally rather than disappearing to the other established hubs?
Yeah, I don't even think it's going to the other established hubs. It's I just don't think there's a lot of understanding. I think that everyone is still very curious about it. So right now, I think on the reinsurance side, I think primarily it's the on the retro side that you see a bit more interest on it. I think a lot of them their portfolio is a bit wider or more global, and so they face a lot of the constraints on retro capacity that everybody else around the world does. So I think for the insurance companies here, they remain interested in it, but I just don't think they know what it is, except for it seems more expensive or something like that, which is rare because actually it should be, typically it's the other way around, right? And so I think, I think it still needs a little bit more creativity with them. I think they would, so for us, I think that, again, it goes back to the people that are advising them. And so I think for us here, one thing that helps is that when we work with the cedents here, we're coming from what we're looking for as well, and I think there's a bit better understanding that way. And so I think it's, again, it comes down to hopefully that distance is a bit closer, so that they can all sort of, everyone can understand a bit what each other is looking for. Yeah.
So that's really building a community around ILS transactions here in Asia, including all the companies and capital providers to support that. Simon, you spoke about sort of the Australian experience and what happened with sort of frequency and secondary perils. And what do you think the ILS market itself can do to help create more structures that would still be appealing to cedents, but maybe strike the right balance between frequency, volatility, and alignment, so that we don't see capital coming in and then exiting?
Yeah, that's a good question. Well, I'll tell you what happened next was the buyers just literally said, well, that's over, we'll just go here. And here was Munich, Swiss, Hanover, Berkshire. So all of the supposed payback went into their coffers, which is pretty galling considering the ILS community had been so professional in paying all those claims. This issue around secondary perils, I mean, most of our values in Australia are on the East Coast. They're not secondary perils to us. Yeah. They're primary perils, and they do a lot of damage. And of course, that was one of the issues is with climate change and more value where these storms were. So the losses were significantly bigger in the floods. I mean, when I came home in 2007, I never really heard of an East Coast low, but they cost billions now. So I guess maybe if it's up to the broking community and the clients to work around those secondary perils, because they need that cover, you know, as much as they want the earthquake and the cyclone, which we don't really need much of anymore because we have our own government pool. So I think that's going to be the challenge, is to get some more and maybe better modelling so that people have more confidence in what's going to happen.
Yeah. No, it's interesting. The East Coast low is certainly something I've never heard of until the last few years, and suddenly seems to be every year. Michael, from the World Bank's point of view, are there things that you would encourage being implemented that might help hubs like Singapore and Hong Kong to attract more business? And governments locally as well, I mean, in terms of how they embrace disaster risk financing. I know that's becoming much more sophisticated around the world. We've seen examples like Jamaica and Mexico who are doing a fantastic job. Are there things in this region that you think would help?
Yeah, well, I mean, first of all, it should definitely credit the grant scheme of Singapore, and more recently Hong Kong, I think, has done a lot in this area. There is a couple of things that grant scheme does for our clients. One is there is a transaction cost sticker shock in cat bonds that can discourage public sector entities from going down that road. Now, frequently when I look at it compared, let's say a 3-year cat bond, put all the costs of a 3-year cat bond against a reinsurance, 3 years of reinsurance that rolls every year and pays a new broker fee every year. The cat bond ends up being cheaper, often, but there still is that upfront transaction costs where if a cat bond's coming with 1.3 million of transaction costs and the reinsurance broker says you'll pay 0 of transaction costs, obviously it'll be part of the brokerage fee. There's a big shock value to that, and then a lot of governments will be looking at this from their Ministry of Finance, and they'll get their debt managers in the Ministry of Finance involved, and their debt managers will say, when we issue a government bond, we don't pay transaction costs like that, and that will discourage by itself entities. So the grant schemes are fantastic in terms of getting over that issue. The other thing the grant schemes do for us is they allow us to do this marketing I was talking about to investors in this part of the world. Because for us to do a deal in Singapore or Hong Kong, meaning we list here, we do a road show here, that will probably increase our total cost for that deal by $100,000 to $150,000. That would not be justifiable without the grant that pays those costs or subsidizes those costs. So it just simply would not be possible for us to do the level of marketing we need to do to Asian investors without the grant schemes. So the grant schemes have been extremely valuable, and I would just, make a very self-interested plug to the governments to continue, because I think they really do incentivize issuers in this part of the world. But it's also just has to be clear that it's a long process with any government to look into this market. Just as some of the investors here today, or some of the, let's say, allocators of capital have mentioned how complicated the market is. If it's complicated for really experienced fixed income professionals, it's even more complicated for public sector workers to understand this market. And it takes a lot of time, it takes a lot of education. And so having not just the World Bank, but having the broker community, reinsurer community, dedicate their time to that education, to the, providing that hopefully free of charge, the education element free of charge to public sector out here would also be extremely valuable.
Great, thank you, Michael. I'm going to switch to you now, Tim. In terms of your conversation with investors in the region, what do you think is required to help build out more investor confidence in the asset class? We've certainly got a few investors in the audience today. I think a lot of them are the asset class is very new to them.
Yeah.
And I assume that's probably the same experience in Hong Kong, where you're based, and elsewhere. This has been kind of the ILS advisor's mandate, was to help grow investor education in the space. Is this still required today? Is it still a hard slog to get people on board?
Yeah, we're still trying to figure it out. But no, I think one of the issues we've struggled with, and I think it was mentioned quite a few times today, the impression is it's a very complex product. And I think that starts with, from my experiences, we always start talking about the risk side, which is natural, about natural catastrophes and the diversification benefits. So the focus is always on natural catastrophes, and then we go down a deep dark hole talking about modeling and all that stuff, and then that's when all the lingo comes up, and you're talking about statistics and numbers, and then I think a little bit of the interest can get lost, or the confusion starts to happen. But actually what we find is actually the investors, they can understand much better, or it's much more aligned with the way they understand things if you're trying to explain the rationale why the risk premium is so high, right? And then so you talk about things like climate change and inflation and all this stuff, which they get will require the losses to be, the loss potential to be higher, and then the capital requirements to be higher, and then we're providing capital, and that's why our capital becomes more valuable, and then we can charge higher premiums. And I think they can get that more understandably. That's more along the lines of what they're investing in on their normal traditional investments. So I think that's something that we've tried to focus on more. And then once you realize actually a little bit that the premium or the compensation is at a level that that risk becomes a little bit more tolerable, I think.
Yeah. No, it's interesting. You allude there to the sort of the fundamentals of what is within an ILS in terms of the risk and return, when the bit that's often harder to understand is the cycle and the fact that the reinsurance market also has a bearing on premiums and yields in this space as well. Simon, you're sort of in Australia. Obviously, you've got some very big allocators there, some who are quite long-term in the space as well, and have been invested in ILS and providing capital to the sector for many years. Are you surprised that isn't more broadly replicated in Asia Pacific? There's obviously a lot of very big investors here too.
I don't quite know what the real number is, but it's something like 5 billion a year comes from the Australian superannuation world into the ILS space, there or thereabouts. I think sometimes they look out the window at the weather and say, just no Australian risk, right? And that is a shame. And there's always that tendency to go to New York and go to Bermuda when, in fact, you can do everything here in Singapore. It's a great place to do business. Don't underestimate the benefit of the time zone, by the way. We love dealing with Singapore because it's basically on our time zone. But they're very sophisticated, those super funds now, and they grow constantly. And they're about to grow even further with the new allocation that's mandatory in Australia, going to 12% of everybody's salary. So that they're always looking for places to put their money, and they've got experience in it. So there's no reason why it shouldn't be more focused here in Singapore as a hub.
Yeah, just a different sort of investor mindset, I suppose, here at the moment anyway. Cheryl, moving to you. We have a number of local family offices and asset managers here, and I know the Monetary Authority's done a lot of work in educating local investors and trying to get them up to speed, and I think that's really critical for the future of having an ILS market. Maybe not immediately, but you want to have local capital having interest in it as well. It will help to stimulate expansion. But in your work, what are you seeing from sort of local investors, and do you think local fund offerings here might help as well? That could help to provide something that's more readily accessible to people, I suppose. And what else are you doing to sort of help with the Monetary Authority activities in terms of educating local investors here, who you must work with in other capacities at the firm?
Okay, so I think there's definitely growing awareness of this asset class, particularly with news about the sensational returns from 2023. In terms of how our firm has gone out to try to educate the local capital market participants, my colleague, actually Simon, he's actually pretty active in this space. He has met and spoken to many family offices on ILS, and we understand that the bigger single-family offices are actually aware of and actually investing in this asset class. But in our view, there are definitely some challenges trying to reach out to various family offices because firstly, there are many of them. And secondly, there isn't really a single platform to do so. And I think there are still some who are more traditional, conservative in the investment appetite. So, if they are unfamiliar, this is obviously something they would not consider investing in. So I guess from a broader perspective, local fund offerings can really assist in educating investors, can generate interest by publishing reports, maybe more in-depth reports on the returns, what the risks are, and what these underlying assets are, and to share historical data to, this helps to build trust in the product, and ultimately they are more able to make more informed decisions. And of course, organizing seminars, workshops, and all that definitely goes towards a long way to kind of demystify this asset class.
Yeah. In terms of interest here, I mean, we have anything up to sort of 60,000 readers a month on Artemis, and sometimes that can be 12 to 15% from Asia Pacific. So it's certainly up a lot from 5 years ago, where most of our readers were Zurich, London, New York, Bermuda, and now it's really gone global. And certainly there's a lot of interest and a lot of people looking for information. Michael, your deals get broad investor support. You alluded to this earlier, but it does seem there's always a concentration, obviously, where the ILS fund managers are, Europe, Bermuda, US, and somewhat from Australia, I guess, as well. But you said you're trying to educate investors here, and obviously you'd welcome investor participation. But what are the challenges, you think, at the moment to really making Asia Pac maybe 5% of a World Bank cat bond issuance?
Yeah, I mean, we spend a lot of time with, I would say, the kind of investors who I would expect to be capital allocators through ILS funds into the market. So, I mean, I guess the fact of the matter is we don't always know how successful we've been, because we may see the same 30 ILS funds in the order book, but where the capital behind those funds is coming from is, not totally transparent to us. So when we do a tour through Asia, talking to pension funds, talking to family offices about ILS, we won't immediately know whether we've been successful or not, because I wouldn't expect most of those parties to come in directly, and it's probably not even a very good idea for most of them to come in directly, at least without some experience through an ILS fund. Because I mean, I think the worst position you could be in would be an investor, who's bought just their first cat bond, and so your cat bond portfolio is made up of one risk. That would be a very sweaty way to spend time looking at risk if you have just all your risk in one basket. So we do this. I mean, maybe you could say it's a sort of a foolish thing. We do all this investor outreach without really having a way of benchmarking whether it was a success. I mean, we're almost, we don't want to be sales agents for the big ILS funds, but in a sense, that's what we are doing, because we're trying to get these underlying capital allocators. And I think, ultimately, you've got to look at, and the ILS funds, of course, will be looking at where do they get their money from in Europe and the US, largely in Australia. And I doubt it's largely family offices. I'm going to think it's largely pension funds. So that's who we think should be probably the target out here as well. I mean, family offices, that's a great complement to the market, but I think it's probably the big pension funds where most of this money should be coming from.
Yeah, I think you're right. I think it is still largely pension funds, and certainly most are accessing the asset class through the specialist ILS managers who provide a great platform for them. So we've got a bit of time left, but I'd like to actually move on to the title of the session now and ask you where you think we could be if we were to come back to Singapore in 10 years or somewhere else in Asia and hold this event in a decade's time. Where would you really like to see this marketplace? Asia Pacific's role within ILS and ILS activity within Asia Pacific specifically. Tim, I know you have a lot of views on this, and we've had long discussions about this in the past, but maybe give us a view of where you'd like to see things get to, not talking about your own AUM, but and then a few short points on what you think really must happen to get us there.
Yeah, I think the key is hopefully if the money is here, if there's money coming allocated through Singapore, then the managers are like myself. We want to be closer to wherever the money is, and so hopefully it's similar to Singapore and Hong Kong are probably much more similar to Switzerland than it is to, say, Bermuda or other places. So hopefully, if you look at the history of the investors from Switzerland, they're largely out of like one or two funds, and way back when with one private bank really, and then probably they're all derivatives of that. And so similarly, we hope there's whether it's myself or our fund or another fund that's out here, they can be successful enough, and then they're sort of a catalyst, and then there's 10 years from now there's quite more out of Singapore. And I think that's the most important part, because once that's there, then fundamentally everything else will be fine. Because I mean, the infrastructure here in Singapore is already actually better than I think people give it credit for. The service provider is actually quite strong here, and they can get everything done and all that stuff. It's just, if the business is here, it will be fine. And so I think getting the investors through Singapore or wherever the money is from, it doesn't matter, but through this part of the world, and then naturally managers like our funds like myself would want to be close to there, and then I think from there everything can progress quite a bit faster. As opposed to now, I think one of the problems is we have the grant scheme, which is fine. We have the service providers are here, that's fine, but the other two sides is still a bit tricky. So even though everything can be done, it's just there's still a lack of investors from this side of the part of the world, and also probably the business is still not ready yet as well.
Sure, yeah. No, it takes time. I mean, it took long enough for Bermuda to get its first cat bond. Cayman Islands was really the dominant home of cat bonds when the market began. We registered Artemis with a Bermuda domain before there was any ILS activity in Bermuda really at all, apart from a small amount of collateralized reinsurance. And it took a long time for that to grow. So I think it does take a while to develop the ecosystem and the understanding and the experience. Cheryl, you've already mentioned a few things that you think might need to happen, but what would be catalysts for you, do you think, at Rajah and Tann? What do you think would really help to stimulate growth here and give us something to talk about in 10 years' time?
I think, if there are more transactions, everyone will be more familiar. And with familiarity over time, with the different features in various structures that would naturally evolve in Singapore itself, the time to process, for example, an ILS application or renewal will likewise be very much faster and streamlined. And the Singapore market in general will then mature to a point where the time to market would be no different from other leading ILS domiciles. That's where we hope that Singapore progresses to. Additionally, I think, over the years, there would definitely be increase in usage of fintech solutions to enhance the efficiency of our ILS market. So you could leverage, blockchain, use smart contracts, and do that for your risk modeling. So if we can do all this and reduce the overall compliance costs that I mentioned earlier, Singapore would then be able to position itself as a leading ILS hub in Asia, and take advantage of its existing position now as a significant financial center.
Lower costs and higher efficiency.
Yeah.
It's music to my ears. When you talk about technology and there's so many different points in the touch points that happen throughout a transaction within this market and traditional reinsurance that we can still improve and make more efficient and ultimately lower the cost of capital for everybody in the industry and do more good work in terms of deploying capacity as well. I think there's a massive amount of opportunity there, so I'm glad to hear that. Thank you, Cheryl. Simon, you really helped at Steadfast Re to sort of drive the uptake of alternative capital in Australia, and you've spoken about some of the challenges that occurred with the weather there. But what do you think Asia can learn from that, and where do you think the overall Asia-Pacific marketplace for ILS could be? I mean, it's a big component of your business still in terms of accessing these markets.
I mean, 10 years from now, what would my younger colleagues like to see? What would success look like? That's probably the way to think about it. I certainly think, the government stuff, the grant scheme should be long gone by then, for all respect to Michael. But certainly there shouldn't be grant schemes for commercial deals, as there has been in the past. Obviously, I'm a bit out of touch with the cell structure, but the last time I looked at all this, it wasn't there properly as it is in Guernsey or Bermuda. I think one of the bonds that was done early on ended up going through either Guernsey or Bermuda. I can't recall which one. So that should be here. Those service providers for the cell legislation should be all sorted, and those service providers should be here, and there should be 3 or 4 or 5 of them, whatever that is, and they do a great job and have an important role. And then there should be 4 ILS managers here, with billion here, billion there, 4 billion, whatever it might be. At least you'd have to think 10 years from now, what is success for Singapore? I love Singapore. It's our preferred destination to come and place reinsurance rather than Hong Kong, or respect to Hong Kong, but we would rather be here doing that. And I would say there should be 4 fully operational ILS funds, maybe more, maybe there's 10. And so you can just come here and do your deals rather than necessarily having to keep going over to Bermuda, which costs a lot more to do. That's probably what I think success should look like. And the government here and the MAS are very good at enabling things to get to these sorts of places, which I think is really, really important, the way they do that, which is incredible.
Yeah, thank you, Simon. I think you made a good point about the grants really shouldn't be here in 10 years' time because
it's easy to spend other people's money quickly. And that's what I think in some cases, one of the ones I looked at, the fees were wild, and I was like, that's just crazy.
Yes.
But
it's still a very expensive transaction to enter into, especially for the first time for a season. So those costs really do need to come down. So hopefully we'll see efficiency, more infrastructure, as you said, around the special purpose vehicles that are here that people can use, and then more managers, either having satellite offices or actual dedicated managers based here. That would all be fantastic to see. And Michael, from your point of view, I mean, obviously you'd like to see all of these things, but is there, what specifically from the World Bank point of view, where would you like to see the World Bank's cat bond activities in Asia Pacific in 10 years?
Yeah, I mean, for me, it's hard to think 10 years, because in 10 years, I hope I'm retired and have no idea what the Asian cat bond market looks like. But from the World Bank perspective, I think it'd be realistic in 10 years to have 3 countries in the region, and I'm talking from the public sector, 3 countries which are regular issuers of cat bonds. So in other words, have cat bonds outstanding, and we have great confidence when those mature, they'll be rolled over as part of a strategy. I think that's very realistic. And then have other deals coming into the market, either other national governments, subnationals, regional groupings in the market. I think it would be really needed to get this activity going for the World Bank, for my team to have at least 2 people stationed in Singapore. That's something we really would love to be able to do if the market was there. And I would say in our order books for cat bonds, as I said, there's often 25 up to 40 names. There's probably 5 firms that put in double-digit millions orders, so 10 million or more. And I would love to see a point definitely before 10 years where at least one of those firms that can put in double-digit order is an Asian-based firm. We have some Asian firms that are in our order books, but they're in at the very small order size right now. So I think having one of those in the top 5 would be a good goal to get to.
Thank you, Michael. And I think what Paul said earlier about how in the United States cedents are beginning to sort of consider ILS first and then strategically work out what the best use of risk transfer and capital is for their programs. I think it would be good to see cedents over in this part of the world begin to do that in time as well, and perhaps look at alternative capital in a slightly different way than they do now. I think that would be healthy for the market.
And I got to put in one more plug for the grant scheme. I mean, when we do the grant schemes, it is invaluable to get the governments to move. And these are closely audited. So if anyone is getting a grant based on grossly inflated transaction costs, I don't know how they're doing it, because we're under a very close audit when we do that. So I do think the grant schemes are valuable.
Absolutely, and I guess there's also a call for lighter documentation maybe in 10 years' time.
But that's like in the U.S. whenever we have an argument about how can we get better public spending, people say, well, let's get rid of waste. Absolutely, let's get rid of waste, but that usually doesn't solve the problem, right? These transactions are expensive. I still think they're very price competitive versus insurance, if people are willing to look at the total costs. But there is an upfront cost, and no matter how much technology we use, I don't think it will become, immaterial, the upfront cost.
Right. And people often undervalue some of the features of the catastrophe bond, in particular, the ability to layer them and have rolling maturities over years, and then the variable reset feature, which is extremely valuable to cedents as well. So there's a lot of good things in there too. Right, we've got a few minutes left, but we should probably turn to the audience and see if there's any questions. I know it's late in the day, but I'm hoping some of you might at least have some final thoughts you can share with us, questions or statements, whatever they might be. We have one. Alex?
Take the opportunity to ask Michael, as I did last year as your moderator. Have you got any closer to finding out the gap between, for example, the LATAM risk pools situation where there's much better take up there, but not so much in APAC? And maybe to tie that in as well with the willingness to pay, because I think a lot of the panel was about the investor sentiment and maybe the costs, transaction costs, but maybe less so about, for example, is the issuer willing to pay?
Yeah, it's a good question. I mean, I think what we see in Latin America is, although all these risk pools are for developing countries, there's a slightly higher level of economic development in the countries that, say, are members of CRIF, particularly now that Central America is part of that risk pool, as opposed to the risk pools that have been created in Asia, which are, for the most part, but small island states, or Southeast Asia, but with the focus on the poorest of the Southeast Asian countries. So there's a different financial profile of those countries, which suggests that, I think it explains most of the reason why we've seen more paid take up in Latin America, just because they're able to pay more premium. So I think that's a little bit insider for probably most people in this room who don't know any of these risk pools. But in any way, I think that's the reason.
Any other questions from the audience? No? Oh, okay.
In case, just for Simon, as a fellow Aussie, yeah, apart from minister trips to Lloyd's to convince them that we are, in fact, a viable insurance market, you do know this, right?
What was the first
We did have ministers who went to Lloyd's recently.
Oh, yes, I'm sorry. Yes, Stephen
Correct.
Conroy.
How do we actually lure investors back in? Like, for example, with the ARPC, cyclone pool that you mentioned earlier, it hasn't been tested yet, touch wood.
It has actually been tested.
Oh,
The claims are tiny.
Materially tested.
It hasn't been materially tested. It doesn't currently buy any reinsurance as yet, but I guess
would we go the way of, for example, the EQC issuing a cat bond at some point, and maybe that might be the way to get confidence back into the market?
Yeah, you could. And ideally, APRA doesn't require the prepaid reinstatement, because if you had a tower of cyclone only with no reinstatement, just one cover, then the ILS market would be very attracted to that, I would suggest. But it's this drag of the free reinstatement, which is to the benefit of Munich Re and Swiss Re and Hanover Re and all those sorts of people. They don't care about that. But this is people's money, and so they need a good return on it. I don't know if that answers the question, but it's the same answer.
Great, thank you, Alex. Anybody else? Any final questions before we wrap? Oh, there we go. One more.
Thank you very much, everyone. Michael, just have one bit of sensitive question. I had a chance to travel to some sanctioned country, and then so we were considering to do some infrastructure development project over there. But when we had a chat with the various potential stakeholder, everyone was a bit hesitating it because of sanctioned environment. But those countries, they need a lot of support from us. Then the one subjectively, one potential idea for the development, they were asking me, can you please work with the World Bank on this project? But sanction is very difficult and sensitive for everyone, but World Bank can consider this kind of activity just for those countries. Yeah, thanks very much.
Yeah, it's an interesting point because, we have 189 member governments. Some of those are subject to different sanctions by other members. And we can certainly work with all of them. We're not subject to those sanctions. However, the reality is if we're placing a transaction in the market, our investors will be looking at will be subject, or some of them will be subject to those sanctions. So even though we could, in theory, be an intermediary for a transaction like that, it may simply be impossible to place, depending on which country it is and which country's sanctions are involved. So, I mean, we can certainly talk if you have a specific case you want to talk about, because again, we can work with any member government. It's just it may become impossible because the market just wouldn't be able to buy that risk.
Okay, on that note, I wasn't expecting to end the day with sanctions. But there
Well done, Steve.
Thank you very much to the panel. Please put your hands together for these 4 people.